The Federal Reserve just flashed us a signal on whether or not they're going to be cutting rates in December. At the last FOMC, Jay Powell threw cold water on the idea of a third rate cut, but that may not be the case. In this video, we're going to break down what is the signal that they flashed. Are they going to cut rates in December? And if they do, what does that mean for crypto? If you're excited to learn more, like and subscribe down below, and let's hop in to today's video. Now, guys, there's been a lot of confusion and drama about whether or not the Fed's going to cut rates in December. And if you look at your screen, it's been kind of a turbulent path. At the beginning of the month, we're starting off at a 70% chance, 75, and then, maybe a 60, okay, maybe a 50% chance, and then all of a sudden we're down at a 25% chance. This is when markets really started to nuke, and then the Fed gave us a signal. So the New York Fed President, John Williams, came out and basically told us that he could see policy rates moving a little bit closer to neutral. And then look at what happened. We went from a 30% chance and we skyrocketed up to a 70% chance. Having a look at the CME group, we are now an 85% chance of rate cuts in December. So why is this? And why do I think that, regardless of what this says, we're going to have a cut in December? And so the main reason that the Fed will likely cut in December is because the labor market is struggling. And this is something that we've been talking about for a lot. Whenever we talk about the FOMC, what the Fed's going to do, we have to talk about the labor market, which is worsening because of the high Fed funds rate. And so here's another chart, and I've showed this a few times recently. United States not in a recession. This is what the Fed will tell us, but the data tells us different. Total share of population and economic expansion below 20%, the worst since COVID, the worst since the great financial crisis. Something's got to give. When did the problem start? In 2022. And then one more for good measure. And so financial conditions are not restrictive. That's what they'll tell you. Small business owners might disagree. Credit availability for small businesses, the lowest since the great financial crisis. This is basically just how easy is it for small business owners to obtain financing or to get a loan to help their business grow and expand. And so I got a clip here I want to show you. We got PNC's Young Yuma on CNBC. He's going to explain why he thinks the Fed's going to lean dovish in December. Have a listen.
Yeah, definitely. I do think there's a very high likelihood the Fed will cut in December. Once John Williams came out and gave positive comments about cutting, I think a lot of Fed members are on the fence, will fall in line behind that, and I think the prediction markets reflected that.
And so once New York Fed President John Williams comes out and gets dovish, some other Fed members fall in line, and now I believe we have the votes necessary on the FOMC to push through another rate cut, a third rate cut in December. I think this will be a 25 basis point cut. Nothing to suggest that they're going to do 50 at this time, although you never know. And I think it's safe to say that Stephen Mirren will dissent for a 50 basis point cut, but what else is new? And I want to show you this quote from Williams. My assessment is that the downside risks to employment have increased as the labor market has cooled, while the upside risks to inflation have lessened somewhat. And so let's break it down. Let's have a look at the data that we got today. We are starting to get more government data now that the shutdown has ended. So this is, we're getting bits and pieces from September. We're really not going to get a full month worth of data until January. That'll be the December data that we get, seeing as how we only opened up the government about halfway through November. We're not going to get a full month until next year. That being said, it's only relevant in so much as it affects the Fed's ability or desire to cut rates. And since it's likely we're going to get a cut in December, I'm not too worried about, the lack of a full month of data. Again, we're likely to get this cut. So it's all good to me. But let's have a look. Consumer confidence coming down from 99.5 in October. 88.7 is the latest value in November, weakening household sentiment. Producer price index. So this is how much producers are paying. This represents the first step in the supply chain. Doesn't represent how much retail consumers are paying, but it does give us a sense on how much they could pay. This is how much the producers are paying. So we saw that the September 2025 data was the year over year 2.7, slightly above the 2.6 forecasts, not a big deal. And then the core PPI, this excludes volatile food and energy, coming in below 2.7% forecasts at 2.6 year over year, suggests easing underlying inflation. So we have an over under here ultimately telling us that inflation remains well anchored. And this is what we want to see. So we're well anchored around 2.5%. This is good. This is what we want to see. When you have inflation that's a little bit higher than the 2% target, what's most important is that it is well anchored. You don't want it flying all over the place because then the Fed doesn't know what to do. But if they can say to themselves like, hey, look, it's a little bit above our target, but it seems to be sitting steady at this level, that's fine. We can work with that. We can cut rates into that. So that's good. ADP, private payrolls. This is the private payroll data that we're getting in absence of the BLS data. 13,500 jobs per week being lost from November 8th onward. ADP reported private company payrolls fell on average by 13.5K per week, signaling a softening labor market demand. So let's have a look at some of these other charts. Monthly change in non-farm employment, down and to the right, negative 9.1K. And then this is from the Challenger Gray and Christmas report. U.S. job cuts for October hit a 22-year high, 153,000 layoffs in October. And then Q3, we actually had over 200,000 job layoffs in the entire quarter. That's the worst since COVID. So you figure in the month of October alone, we almost reached the entire Q3 layoff number. It shows a rapidly deteriorating labor market. The case for rate cuts is there. And I want to show you one more clip. This is from ADP's chief economist, Neela Richardson. Check out what she has to say about this latest round of jobs data.
It's telling us that the hiring momentum is slower than what we'd expect at this time of the year. And that's for a variety of reasons. The biggest wild card in terms of employment and hiring right now is the consumer. A downbeat consumer, will that resilience that has fostered growth in the second quarter of this year, will it continue? And that's what we're seeing in these hiring numbers. They are delayed, possibly curtailed, but the momentum is not what we're used to seeing at this time of year.
And so what she's basically telling us is that we're seeing a weaker than average consumer. And again, that's evidenced in the consumer confidence dropping by almost 10%. And then this chart, again, showing you that U.S. households are stressed out. And the problems, they begin when the Fed hiked rates to 5.5. And if you've watched our videos over the last few days, you'll understand why that's relevant to our bigger macro crypto picture. Go back and watch those videos if you haven't. Gives you a good sense of where we are and where I think we're likely to go in crypto markets as we head into 2026. And so what does this mean for us? So we're getting 25 points in December, most likely. What does this mean for crypto? Why do we care? And so the Fed cutting rates is a step in the right direction. It's easing financial conditions. It's providing more stimulus to the economy. And it's getting us closer to the neutral rate, where the Fed isn't restrictive, but they're also not too loose in their monetary policy. Right now, we are still restrictive. We're seeing that come through in the data. It's why the labor market's weakening. It's why the consumer's weakening. And to be quite frank, it's why the crypto market is kind of lagging behind. And we're not seeing that expansion in the business cycle that I talk about so frequently. And let me show you this chart, channel favorite, percentage of central banks cutting rates and the ISM. This is how we measure the business cycle. As the business cycle goes higher, Bitcoin dominance falls. But what we're seeing is that we're staying sideways here in this business cycle indicator, which means the economy can't expand because households are stressed out. People don't have any money. Alt season is a retail-driven speculative frenzy. And if retail's stressed, if consumers are stressed, they're not going to be going in to riskier, more speculative plays. They're either going to stay in the safe plays like Bitcoin, maybe Ethereum, or they're going to stay out of markets entirely. They might even sell their bags if their situation gets dire enough, they need to raise some extra cash. And so when we see rates go down, you can see the connection between the Bitcoin price. And this is a reflection of the crypto market more broadly. Bitcoin is really just a broad reflection of how risky the market is feeling, how bullish the market is feeling. And as the Fed funds rate goes down here in black, Bitcoin tends to go higher. As the Fed funds rate goes higher, Bitcoin tends to stall out or even sell off. And so I'm not here to tell you that a Fed rate cut in December is going to make us go into an immediate alt season. I'm not telling you that it's going to even make a significant difference in the short term, but it's a step in the right direction. And this is what we want to see. We want to stack up small wins at this point. I believe that 2025 has been more of a halving year instead of a post-halving year. And again, I've done videos as why I think this, but we want to just keep stacking small wins, 25 here, 25 there. Before you know it, we're at 2% interest rates and the economy's flying. Everyone's feeling better about their financial situations. And then we can see that broadening out from high caps down to mid caps, low caps. And then before you know it, we're in alt season and everybody's happy. But until then, you've got to take our wins where we can get them. 25 in December, to me, I'm happy with that. And I hope you are too. And so I hope this has been helpful for you. I hope this helps you understand where we are in the Fed picture, what's likely to happen in December, and maybe you can make some plans around that. But ultimately, my sights are set on 2026, and I'm stacking small wins until then. And if you want to stack as much knowledge as you can in this ever-evolving crypto market, you got to like and subscribe down below. Leave me a message. Let me know if you've learned anything. Has this video been helpful, or do you really not care? Either way, thank you for being here, and we'll see you in the next video.